Prasad. He is the Tolani Senior Professor of Trade Policy at Cornell University, also Senior Fellow at the Brookings Institution, and we're talking today here in Singapore. Dr. Prasad, so nice to speak with you today. Perhaps we could begin our discussion and let me ask you to explain what is the dollar trap?
The dollar trap is this very strange situation that the world economy finds itself in. Since the financial crisis, there's been this desperate urge to have protection. Emerging markets want a safe place to put their money so that when their currencies or capital accounts come under difficulty, they have some hard currency reserves to turn to. Private investors want safety. Financial institutions are being asked to hold more safe and liquid assets. But the supply has shrunk. The Eurozone isn't what it used to be. So there are other countries like Japan and Switzerland that are considered safe places to put their money, but they don't want money coming to their economies. So they become net demanders of safe assets. So who's left to fill in the gap? The dollar. And the paradox here is that the safety that the world is looking for is to some extent from the effects of US policies themselves. So what we've seen repeatedly since the financial crisis is that every time there is turmoil anywhere in the world, people want a safe place to put their money. And the US is the only game in town.
That sounds like a good thing that there is a safe haven. Why do you call it a trap?
It's a trap because the world would like to have an alternative place to put the money. Putting so much money into US dollar assets is not something that world central banks feel comfortable about. And the situation here where US policies themselves create turmoil in global financial markets is not necessarily a good thing because that imposes less discipline on US policies than would otherwise be the case. If the US ran bad policies, created trouble for the world, then you would expect money to flow out of the US and that would be a disciplining mechanism. But because the world has no other place to hide, everybody comes to the US for safety. So this is not necessarily good for the international financial system. It's true, given the turmoil, it's nice to have a safe place to go to, but if that safe place itself is generating some of the risk, it's not such a good thing.
Could you elaborate a little bit more? If we go back and think about the global financial crisis of 2008, 2009, so many people thought that the US dollar would lose this status of being a safe haven currency, and people started to think about the renminbi and the yen and the euro, as you mentioned. Is it just everything about being relative?
In international finance, ultimately everything is relative. And the story I tell in my book is not a story of American exceptionalism. And it is a curious paradox because, after all, the global financial crisis did have its origins in the United States. The US has built up a massive amount of government debt since the crisis, and the US Central Bank, the Federal Reserve, has been pumping enormous amounts of dollars into the global financial system. You would think, logically, that this should lead to a decline in the dollar's value and its prominence, but quite the reverse has happened. The dollar's value has held up quite well, and if anything, the dollar has strengthened its position as a global reserve currency because, again, there are no good alternatives.
Are you suggesting that the dollar then is invincible?
It depends on what aspect of currency dominance you're thinking about. Now, the dollar serves many functions like any other currency. It's a unit of account, it's a medium of exchange, and a store of value. As a unit of account, the dollar is very important because when you think about commodities like oil, all oil contracts are priced and settled exclusively in dollars. As the costs of trading in other currencies fall, as other countries have deeper financial markets, you can see the dollar having less prominent a role there. If you take a country like China, which has become a very large trading nation, China has signed currency pacts with its major trading partners like Korea, Japan, and so forth. But it's a store of value that the dollar really comes into its own, and there it's hard to see any viable challenger in the foreseeable future. It's possible the Eurozone may get its act together. It's possible that the renminbi may end up being backed by very strong institutions and a good financial system, but I don't see those as being on the cards.
Well, perhaps you could elaborate a little bit more on the renminbi because there's so much interest in China and in the renminbi. China has become a very strong trading nation. Its economy is on track to potentially overtake the US. What are the prospects for the renminbi, and why isn't it a strong candidate for being a safe haven currency?
Now, it's important to make a distinction between different aspects of a currency. One is as an international currency, meaning a currency used to settle trade and finance transactions. And there, the renminbi has gotten a fair amount of traction already. Again, just because of China's economic prowess, it accounts for a very large share of global GDP now. It's the second largest economy in the world and could catch up to the US over the next decade or so if it maintains its present growth trajectory. It's one of the biggest trading nations in the world. Now, to become a reserve currency, however, the renminbi needs to have behind it very deep financial markets. China needs to have an open capital account and a flexible currency so that foreign investors can actually acquire and be able to trade in renminbi denominated assets. China isn't there yet, but is making progress on these dimensions. The argument I make in my book is that to ascend to safe haven currency status requires an entirely different set of institutions. It's not just about economic size or financial markets, but other institutions, including an open and transparent system of democratic government, public institutions, including a central bank that the world is willing to trust, and an independent judiciary. Now, those are the sorts of reforms that I think China is not yet ready to make a push on.
How does the euro look then in this context?
The Eurozone seemed like a viable contender for the dollar in the early years of its inception. In fact, in the first 5 years after the euro was created, it did account for a significantly greater share of global foreign exchange reserves than at its inception. But it turned out that the Eurozone financial markets were not that deep, so the euro couldn't compete with the US. The share of global foreign exchange reserves held in euro flatlined after about 5 years. And the global financial crisis has hurt the euro a lot because it's become very clear there are enormous fractures within the Eurozone. Could the euro become a viable competitor again? Yes. That would require the Eurozone to have not just monetary union, but also banking union and fiscal union. In other words, for the Eurozone to become a true economic union. They talk about it, but I suspect it's going to be a long way away, and the political challenges are immense towards creating this sort of true economic union.
Is there a cost to the United States for having the US dollar be a reserve currency and a safe haven currency for the rest of the world?
You might think that having a strong dollar and having a reserve currency that the world is willing to accept in essentially unlimited quantities is a wonderful thing for the US economy. And certainly it has benefits. It means very cheap imports for US consumers and very cheap financing for those imports if foreign investors are willing to put money in the US at very low yields. But there is a cost as well. If the dollar stays stronger than it ought to be, it hurts export growth and job growth in the US. And especially at a time like this, when the US labor market is still getting on its feet, although it's been doing much better recently, every little bit would help, and this is not helping the US. But the bigger pernicious effects are somewhat more insidious because the real problem is that the lack of discipline from other countries on US policies means that the US can get away with policies that are not in the interest of the world economy or at some level in its own interest. And that, I think, is ultimately not that good for the US economy or for the global financial system.
What are some of the elements that could potentially impact the US dollar's dominance?
Now, it's again possible that you have viable rivals to the US dollar, but I don't see that happening because, again, given all the elements of this magic sauce that the US has put together, it's going to take a while. China might build financial markets in the next decade or so that give the renminbi a significant reserve currency status, but building institutions that domestic and especially foreign investors trust takes a generation, if not longer. One can think about potential tipping point scenarios where people start wondering whether they're going to get the value of the US dollar assets back. But the curious paradox in international finance right now is that anytime there is concern about the US dollar, anytime there is a downgrade, for instance, of US government debt, anytime the US government comes to the brink of default, all of that simply brings more money into the US dollar because anything happening in the US financial markets would mean turmoil not just in the US but financial turmoil everywhere in the world. And when there is turmoil, people want safety. And when you want a safe place to put your money, it turns out there really is no alternative to the dollar.
It really seems like the ultimate irony, doesn't it?
It is very strange, and at some level, logically, it should be a very fragile equilibrium that could come apart very easily. But now the whole world is vested in this equilibrium not coming apart. Foreign investors, including foreign central banks, hold more than $5.7 trillion worth of US government securities, in addition to trillions of dollars worth of US dollar denominated assets. So if the dollar plunges in value, the US may get hurt, but the rest of the world gets hurt even more. So it's become a sort of self-reinforcing equilibrium, because now it's in everybody's interest not to digress too far from that equilibrium.
So it does sound like everyone is in the same boat.
And it is a trap.
Does the centrality of the US dollars render the emerging markets vulnerable to the spillover effects of the dollar?
It is true that the Federal Reserve has now become the central bank that is critical to the entire global financial system. And the reality of monetary policy actions taken by any countries, given the financially integrated world that we live in, is that when a big central bank takes an action, it does have spillover effects. So when the Federal Reserve undertook its operations, its quantitative easing operations, some of that flowed to emerging markets, fueling asset price bubbles, higher inflation in those economies. And then when the Fed announced last fall that the Fed was going to pull back by tapering its quantitative easing operations, that led to a flow of capital out of the emerging markets. So emerging markets at some level feel they're at the mercy of Fed policies. But this is really a reflection of very unbalanced policy mixes in both the advanced and emerging market economies. In advanced economies like the US, the Federal Reserve is having to do all the heavy lifting in terms of supporting growth. But the same is true of many emerging market economies. Fiscal policy and structural policies are not helping them. So that's the core problem, really. And that seems to be ultimately turned into this notion of the Fed creating problems for the emerging markets. But I think the fundamental problem is this very unbalanced policy mix in the advanced as well as the emerging market countries. And unless we solve that, what happens with the dollar is actually less important than just having this very unbalanced policy mix in each country.
I hope I'm not opening a can of worms here, but I'd really like to ask you about virtual currencies. Bitcoin, and I've just heard recently that Iceland was trying to launch the Aurora coin. Is there potential that they could step in as an alternative?
Virtual currencies and even assets like gold have this one particular appeal, which is they're limited in supply. So the Bitcoin algorithms are set up such that there will be only 21 million Bitcoins ultimately mined. So you might think, given the limited supply, that this is going to hold its value. But it turns out one thing the financial crisis told us is that it's not necessarily the assets that are in limited supply, but in fact, curiously, the assets that can be produced essentially in infinite quantities, like the US dollar, like the euro, that actually turned out to be much more valuable in the system that we now live in. Now, Bitcoin, I think, is also built on faith at one level, just like gold and just like the US dollar. But in the case of Bitcoin, there is no institution backing this faith. In the case of the US dollar, there is a central bank, and behind the central bank, there is a government with taxing authority that can actually raise revenues. So that changes the nature of the game a good deal. But Bitcoin and various versions of electronic currencies, I think, point to one very important issue, that increasingly we're going to move away from paper currencies towards more digital or electronic currencies. But I think what this is presaging is not really a move towards decentralized electronic currencies like Bitcoin, but perhaps fiat currencies issued by central banks that trade largely on electronic platforms rather than in paper or some other tangible form.
Thank you very much. That was very enlightening, Dr. Eswar Prasad. Thank you. Nice talking to you today.
It's been my pleasure. Thank you.